what led to the failure, there's two key things in my opinion. One is they had a really, really narrow niche of their client base was all very similar. Silicon Valley, fast-growing, many not profitable tech companies, which made their deposits at risk in a way, because if there is an issue, it can spread very quickly, the fact that there's an issue, and that's kind of what ended up happening. That's number one, their deposits were flighty. Number two was what they actually did with the deposits. They had significant growth in deposits over the last couple of years. So starting with COVID, when the Fed turned on the liquidity bucket, a lot of these companies were awash with cash, and a lot of it went to Silicon Valley Bank. What a bank does with their deposits is they invest them. They don't just hold them, they invest them. And what SVB did a really bad job with was managing the duration of the investments. So they made high quality investments, meaning they put the money to work in government bonds, which are secure, but they did it, they invested in very long-term government bonds, rather than staggering out the maturities, investing some short-term, some middle-term, some long-term. And as a result, when interest rates rose dramatically the last 12 months, all of those government bonds were worth less on paper. So they're holding an unrealized loss on their balance sheet. The combination of the unrealized loss on their balance sheet and the at-risk deposits, it sort of became a vicious cycle for them, and it ended very, very quickly. The short answer is yes, because it's all sort of related. So there were other banks that had a somewhat similar profile to Silicon Valley Bank. SVB was by far and away the most extreme, and therefore they were the most at risk now that the dust has settled. But Signature Bank, similar profile. First Republic, somewhat similar profile. They don't really have the same client base, but they had this similar issues with balance sheet, and so that's affecting them. And also, it just kind of like once the word starts spreading that a bank could be at risk, it can snowball very, very quickly. We're seeing that, and it's not the same as 2008 at all. And I don't know if you're going to ask me about that. I assume you will. But what happened in 2008 is what was on the bank's balance sheet was actually toxic. There was a lot of stuff that was actually worthless. Because it was subprime, the borrowers were no good, and as the economy was failing, the paper that these banks were holding on their balance sheet just became more and more worthless. There was less of a chance for it to ever rebound. That's not the case here. The case here is not the quality of what the banks are holding. It's just there's a mismatch in terms of what they own and what they owe, relative to the depositors relative to what's on their own balance sheet. And I think we're just seeing this rapid rate hike cycle catching up to some of the banks that are maybe they don't have quite as wide of a deposit base, meaning their customers are too similar. And so when the bulk of their customers can get in trouble or need cash all at the same time. That's not the case at a Citibank, Bank of America, JP Morgan. So those banks are safer for that reason. They can withstand these short-term unrealized losses on their balance sheet, assuming that they hold the same type of paper. I think it's probably the most commonly asked and the most important question this week is what just happened going to affect the Fed's trajectory and how they're going to view the fight against inflation? Because what had been happening leading up to last week was that we had this major yield curve inversion, which, by the way, is partly responsible for the bank's issues. But the short term, meaning the Fed funds rate, had risen enormously relative to the long end of the curve. 4.75% is what the Fed has hiked over the last year, and just that resulted in the 2-year Treasury peaking above 5% last week. It's now below 4%. It's an enormous move for a market that's as large and as stable as the 2-year Treasury. And I think that affects in a huge way what the Fed can do. Are they going to, they have to address it, because what's happened to the yield curve in the last week, it affects the economic conditions that we have right now. And the whole point of them tightening was to tighten the financial conditions, to sort of put pressure on the economy, take some froth out and slow things down. What's happened this last week without them doing anything or making any announcements is conditions have tightened severely. Banks are certainly going to be more cautious in terms of lending. Consumers are going to be more cautious in terms of spending and borrowing. So what's just happened this last week is that a good deal of tightening happened for the Fed. The part of its job was done for it. This is such a weird environment because we've been talking about this for 12 months, this idea that we are either in a recession already or about to go in a recession. How bad and steep the recession is going to be is kind of the only thing that's up for debate. Should we fear a recession? I think the time to fear a recession is when the market is at all-time highs and there's an overwhelming degree of confidence, if not overconfidence, amongst investors and consumers. We just don't have that right now. So that doesn't mean we're immune from a recession. We could be in one right now. However, the data says we're not. We could go into one. That's possible. What's also possible now, and this almost probably makes no sense, we could go into a recession and the market might not fall, or it might not be as weak. We could just kind of, remain somewhat stable at these lower levels than we were 18 months ago. These are the good times to answer what could go right, because every single headline this week and last week has been on what is going wrong, and that sort of snowballs because people hear what's going wrong and they just are just by default focused on what could go wrong now from here. What else could go wrong? And there's a lot that could go right, which we're not hearing too much about. The Fed meeting next week, which will have already happened by the time this video comes out, but the Fed and Powell have just been given a lot of cover to lean dovish. Not necessarily pause on interest rate hikes or cut. I mean, I think it's a little ridiculous to suggest they start cutting, but they could do a dovish 25 basis point hike. And there's a bunch of different ways they can do that. They can say, okay, we need to do one more hike because we're still taking inflation seriously. We understand there's all sorts of volatility in the markets and the banks and the headlines are scary, but we're still taking inflation seriously. However, we also recognize that there's volatility in the headlines and in the market, and people are nervous about banks, the solvency issues, et cetera. But also we've had commodities basically collapse year to date. Oil's come off. Natural gas is in a bear market. So things that consumers pay for have become cheaper. And maybe we haven't felt that yet, but that is happening. So that's one big thing, and nobody wants to call it a pivot, but the Fed could certainly lean dovish next week. That's one thing that could go right. Another thing is the fact that sentiment is so bad, which you highlighted. So when sentiment is bad, usually bad things don't follow sentiment being bad, because it's sort of like the tail wagging the dog. When sentiment is bad, that means things are generally priced in. People who are scared and want to sell have sold.